Yes.
Okay,
Yes.
now we're live.
We're live. Well, welcome everybody to the next Google Hangout for asset pricing. I'm John Cochran, nominally in charge of the class. Let's introduce everybody. Adam and Nina, you guys go next.
Sure. My name is Adam. I'm a third-year PhD student at Chicago Booth, and I'm one of the TAs for this amazing course.
Nina.
Hi, my name is Nina, and I'm a fourth-year PhD student in finance at the University of St. Gallen in Switzerland, and I'm also happy to be a TA for this course.
And let's introduce our guests. George?
Yep.
Introduce yourself, George.
You don't have to pronounce my last name. It's an ugly Greek name.
Well, I can't see it. What is your last name?
Christopoulos.
Good. Welcome, George. Tell us where you are and what you're doing.
I'm right here. I'm working for an FX firm. We are an FX broker. I'm here in Greece. I have my academic background. I have an MSc degree in economics from London School of Economics. I majored in capital markets, which was like quite challenging. It was the first time that I tried to, try to apply my theoretical knowledge in practice. And right now we are in the center. Let's say we are actually trying to, convince people to try to invest, to CFDs, to options, to futures, and try to profit from the volatility of prices. So I'm doing this in, let's say, I'm more on the practical side right now.
Well, you're certainly live in the center of volatility. Leonard, can you introduce yourself?
Sure. My name is Leonard Mangini. I'm from the New York City area. I'm actually in private practice with my consulting practice. I'm an actuary. Been in the industry for about 25 years. I had a bachelor's degree in math and physics, and I got a master's degree in computational finance and financial engineering. And so very interested in how to model interest rates and asset prices and project the future, and worrying about pricing of insurance products and also the solvency of insurers. Well,
I hope you find something useful to all those very interesting questions. And Charlie, last but not least.
Hi, I'm a fourth-year PhD student at University of Connecticut, so I just run regressions all day, and that's no practical benefit at all.
Now, Charlie, it looks to me like you got the prize for art in the background.
Oh, that's right. This is a poster. This is a grad student budget art. It's a poster of some golf, which I don't get to play much up here in Connecticut, but.
Okay, well, let's get going on the Hangout. Adam, Nino, should we start with our guests, or do you have some important things to do first?
No, why don't we start with our guests?
Okay, well, Leonard, go first. What do you got for us?
Okay, I have a question about how to put in macroeconomic trends and cycles into the model. And I had a specific example just for you to perhaps elaborate on. If you look at demographics around the world, particularly EU, Japan, you see a demographic collapse. People are not having kids. They're living longer. So you're seeing a big shift in what you would expect to be labor productivity. You might actually see selling pressure for disinvestment of assets. And I'm wondering how one would put these kinds of macroeconomic factors through the pricing model. Would you just try to predict what productivity would look like and bake that into, say, your stochastic processes in terms of your drift parameters, or would you explicitly change utility functions and then have different cohorts with old people selling assets and younger people wanting to buy them, things like that?
That's a great question. We've got to start with the hard questions at 8:30 in the morning. Well, I guess where you are. So how do you put macro to it? This will be general. I mean, I wish I had solid answers for you. Everything. So in our kind of view of the world, it's either in the cash flows or the discount rates, and you mentioned both of those. One thing, for example, demographics is a good example. Now the Western world's getting old. Not all of the world is getting old, and that poses an interesting challenge. You mentioned demographics and productivity. I think both of those are So as we get older, yeah, we skew towards older people and we skew towards less productive people. So how do we put those thoughts into cash flows or discount rates? Yeah, certainly productivity means the cash flow part might be lower. Of course, on the big picture of the world, long-term growth comes from ideas, really, not from people. But the one thing, let's think about the discount rate part. There's the discount rate and the risk premium. So you mentioned one factor that people talk about, and I think makes sense. If you have a society, young people want to save for their retirement, old people want to dissave, so that there's there's going to be less supply of capital as people get older because they want to use it up rather than save it. You'd think that would send interest rates up. But there's always supply and demand. The secular stagnation crowd these days is making the other claim that interest rates are being driven down because there's too much supply of savings, despite the fact that we're getting older, that modern technology doesn't need as much capital as railroads and bridges and things like that did. So what have I waffled on? There's supply and demand for capital. There is the young people want to save, older people presumably want to dissave, though it doesn't really turn out that way in practice. And then, of course, the big picture of our class is the risk premium. It's not just about saving over time; it's about people's willingness to bear risk. How's that change? So I wouldn't. In economics, we try not to put stuff in utility functions as much as possible. As much as possible, not people fundamentally feel differently about stuff. But as they get older, their circumstances in life change. Perhaps as they get wealthier, their ability to bear risk changes. Have we done anything that's useful for you there?
No, that helps.
Are there particular thoughts? I mean, well, these are fairly straightforward things that people talk about all the time. And that, is there a particular example you had in mind, other than sort of general aging of the population? What does that do?
Well, perhaps whether you're looking nationally or globally, it's a global world, and a lot of sources of funds might be, sovereign wealth funds and things. That you have to look at the whole world's propensity to save and the whole world's risk aversion. So maybe these things smooth out when you. Absolutely.
Now the national versus global is a really important one to keep in mind, because people say we're getting old. So, where are all the savers? They're gone. But we live in a world market. So to what extent are world markets integrated in that way? What should happen is that a young country, as it's saving, ships its capital abroad and then brings it back again when it gets older and wants to dissave. And of course, when there was a puzzle, that didn't seem to be happening. Countries were using their own savings rather than shipping it abroad. Then we started getting globalized, and countries like China were sending us a lot of stuff and accumulating assets, and everybody starts saying, oh, global imbalance, global imbalance. So it's kind of, the world actually ended up starting to work that way. But that is how the world's supposed to work. It's supposed to be integrated. It should matter what the entire world supply and demand of capital is. Now, there are frictions that get in the way, and I think you've got at least the good question to ask. If someone says, well, there's not enough national supply of savings, well, why doesn't it come from abroad? What's standing in the way? Let's see. Let's let George take a turn.
Okay. So, Professor Kocheren, can you hear me?
Yes. Yeah, we're doing fine.
Perfect. Perfect. Well, my question has to do with the equity premium puzzle. Well, I might go, let's say, in last week's material, but it's very interesting just to think about that. It's a puzzle that I don't know. It's 2,000 papers that have to do with the equity premium puzzle, or maybe more. So I have an idea, and I want your opinion whether this is, I don't know, it's a good way to go. One could put some frictions into the model. One could use an RBC and a real business cycle model, and putting an investment function that's not linear. One could use some fixed costs and some, let's say, non-linearities with, let's say, one could introduce the irreversibility of capital. So it could explain part of the equity premium puzzle. I mean, this guy German in 1998 he wrote a very interesting paper, and what he didn't do is that he didn't solve the puzzle 100%. Of course, nobody I believe in the world can do that. But what if somebody could use Abel's augmented adjustment cost function rather than a linear one, and then one could solve the puzzle together with together with habit formation. So I don't know. Maybe this could be a possible solution, because to get past the lack of curvature problem of the standard time separable preferences.
Okay. Now that's a big question. Actually, so I think your answer is a good one. In fact, that's a paper I'm working on too right now, so we'll be racing. But because I think you're exactly right. That we kind of have the ingredients. No, this is free disposal of ideas. We have the right ingredients, I think, in front of us for sort of the right general equilibrium. You know, you need something like habits, something that gets you time-varying risk premium, and you need something like Q theory, adjustment costs, because, again, this is in some sense a response. What Leonard's question brought up, too, was that there's always supply and demand. So it's costless to create capital. The minute the market price of capital goes up, we create more, and you can't. Price to book ratio never changes. So you need something that. But on the other hand, we don't live in an endowment economy. So there's these strong correlations between stock prices and investment. So the general set of ingredients, I think, is exactly right. Something that generates time-varying risk premium and investment. That I'll give you an A+ for. Let me warn, not you, but everyone else, the equity premium. So first of all, another advertisement. We will do an entire week on the equity premium puzzle in part 2 of the class. That was one of the things that I thought was good. You know, kind of you got kind of like the taste, and now we'll go expand on it in second part of the class.
Right.
I want to warn anyone doing research. If you take a puzzle that's 20 years old and has 2,000 papers on it, you're going to have to be really, really smart to come up with something that 2,000 people haven't been able to figure out so far. So orienting a paper around, I'm going to solve the equity premium puzzle, it's a natural idea when you first start doing research, but then as you get older, you realize that the other people doing this are really smart, and you know, phrasing something to solve the equity premium is going to be tough. Why? Even if we put, so the thing you said was you're going to put investment in, but that's not going to stop. The equity premium puzzle is about the joint behavior of consumption and returns. It's kind of independent of the investment process. So nothing we do about investment is going to help on the equity premium puzzle. I do think it's, I do think it's solvable with a combination of. We're going to look at if we look at the data better. I think consumption data. The idea of using monthly consumption data was a good first start, but if we take the data seriously, horizons seriously, and recognize that the ex-ante premium is probably a lot lower than 7%. I think that the equity premium puzzle will eventually make sense, but not by working on the investment side. So I think your idea is an excellent one, but phrased as how do we form a model that explains the facts of time-varying risk premiums associated with recessions, associated with big waves of investment and disinvestment. That's go for it. That's a great idea.
Okay, my question is if I can add something. Can I add something here?
Yeah.
All right. What if we add irreversibilities into the problem and fix very big fixed participation cost, which is a part of reality? This will give us this lumpiness of investment, will give us this extra riskiness that we might need, because sometimes firms do not invest linearly; they invest in lumps and booms. So this will give some extra volatility and some extra variables that we will have to calibrate the model and try to play with the habit formations, not just have gamma. We will have an extra variable, and this will give us, this will separate this RF, delta plus 1 plus gamma, and it will be two different stuff. So what I think, what I suspect is, I believe that we find a way to at least partly explain this extra, let's say, returns from stocks.
So this is great because it gives me a chance to bring back to a lesson from the class and to use my whiteboard, which I went out and bought yesterday. So we can test the whiteboard technology here. So remember, we did in the first part of class. I made this drawing here where there's a production function and a utility curve, and here's a couple of production functions, and this was consumption at time t and consumption at time t+1. Now, can you guys see the whiteboard?
Yes.
Is that going well? Okay. So what lesson does this graph tell us? It tells us that the relationship between utility and this was the asset return here. The relationship between utility and the asset return is the same no matter what the underlying production technology. So this was the justification for using endowment economies when in fact we knew that there's some sort of production economy. Now, so once you've correctly modeled the consumption process, the equity premium is this observation that consumption is seemingly too smooth to generate risk premiums. Once you can if you correctly model the consumption process, changing the underlying technology that produces that isn't going to affect the relationship between utility and consumption. So changing production technologies is just not going to help you on the equity premium puzzle, because the equity premium puzzle is the relationship between consumption, marginal utility, and asset returns. You can only make improvements on the equity premium puzzle by changing utility functions or a market structure facing the consumer. Changing the production function, now that brings in data on investment, business cycles, and so forth, and it answers general equilibrium questions. It answers why don't firms, why don't firms respond to changing prices in the market. But you're not going to get far on the equity premium puzzle by changing the production technology. That was the. I hope I've made that clear. That was the point of that graph.
Yeah.
Now, irreversibilities is really important, and there's a whole literature on this. 2 papers to read. Ricardo Caballero wrote a bunch of them, and Julia Thomas wrote a follow-on. The big question is whether individual company irreversibilities make a difference in the aggregate. Because once you buy a house, you can't turn that house back into hamburgers. But if how many people are on that margin that they really want to do that isn't obvious. So do irreversibilities make a difference to the aggregate production possibilities? There's a big literature on that, which we won't survey now because we actually at some point we need to get to talking about this class. Let's give Charlie a chance, and then we'll move on.
To follow up to bring it back to the class. There was a question on the forums, and I think the commenter was, he was saying, hey, you've talked about asset market clearing, but where's the goods market? What's the goods market clearing? And I know that's important in general equilibrium, and I think there's something important there. And we wrote down P equals EMX based on the law of one price, and so we're not really in general equilibrium yet. We're a little bit short of that, right? We don't need. I guess maybe you can explain better, but what do we need to be able to write? We do our CAPM proof without appealing to a whole. We don't write down firms. We don't write down a whole GE model. Unless maybe there's something stuck in there that I don't understand, but maybe.
Well, we can. So we can make this. There's no trick. We can make this a complete general equilibrium model if we want to. It's extraordinarily simple.
Right.
And how do you? Let's call. Let me get rid of this. Here's our general equilibrium model, and it includes firms and good market clearing. So what is it? There's an endowment. We live on an island. Coconuts fall every day and they rot overnight. Coconuts C default fell today. Coconuts CT+1 fall tomorrow. It's an endowment economy. There's goods market clearing now. The good market is kind of boring. The coconuts fall down, and you can't really trade. There's no labor. There's no capital. You can't really trade coconuts for coconuts. But The only trade then is coconuts today for coconuts tomorrow. So we trade assets that are claims to coconuts, and that's a full general equilibrium economy. It's a too simple one if you like. Fine, we can always you can add multiple goods. We've talked a little bit about that. You can have utility of consumption and leisure, and then think about an underlying production technology. And then our friend P equals E of mx will be one of the. It is really just one of the equilibrium conditions of a general equilibrium economy. And so you can write down a simple endowment economy in which consumption, where the endowment's exogenous, and then this is the only equation of a general equilibrium. But of course, that's not realistic. But this remains in any general equilibrium. This remains one of the and we sort of asset pricing studies that one. Labor markets study marginal rate of substitution of labor for leisure equals wage rates, and so forth.
If the goods market wasn't clearing, there's some cultural norm against picking up certain coconuts. Does P equals E equals MX hold? Do we need, can we have a friction in the goods market but still write down using the law of one price and still prove cap M holds, under certain consumptions or certain assumptions?
I'm going to guess yes. P equals E of MX, so let's try to remember. Again, all I can remember is that you know everything I know. So let's see. We have a theorems about when does P equals E of MX hold, which involves absence of arbitrage, law of one price in the asset markets. Right. So if the asset markets are, as long as those mild conditions hold, the issue is whether M is properly connected to U prime of CT plus 1 over U prime of CT. There's a lot of P equals E of MX. Okay, yeah, back to the class. P equals E of MX is fairly innocuous. It's absence of arbitrage. It's law of one price. The issue is what does M connect to? Is M connected to marginal rates of substitution of the representative investor? Is M connected to marginal rates of substitution of the subset of investors who trade in stock markets? Is M connected to the leverage of financial intermediaries? Is M connected to the psychological fads and fallacies emanating from Yale? Those are all fine view, now I think with the sort of thing you sketched out, something's wrong in the goods market could lead us to being on our first order conditions intertemporally, but not. Yeah, let's put a big way. Well, we live in such an economy. There's a big tax wedge between labor and leisure. Big taxes. So we know the marginal rate of substitution between labor and leisure is distorted relative to the price ratio of labor and leisure. But nonetheless, we could have undistorted asset markets. Well, there's taxes there too, but so I think as a subset of that first order condition can work even when lots of other ones are screwed up. It's just a first order condition. In effect, we're really looking at just that one little aspect and then thinking about how that fits in a general equilibrium or a non-general equilibrium. Okay, let's. Why don't you guys stick around because you may have. Let's talk about the class. Adam, Nina, do you have some good forum questions for us? And Charlie, Leonard, and George, help us to answer these in ways that are useful to people in the class.
Okay.
Yep.
Let me start with the forum question, and it is from Bjorn. He says, I have read and been teaching only the theoretical parts in discrete time from your book already from the time when it existed as a PDF file. Now, as an emeritus, I have the time to follow your course and it gives me an immense intellectual pleasure. Now a question. I have always been wondering why you always just state that expectation of xy is equal to xy as a standard Euclidean inner product. I understand that the whole grammatic exposition becomes complicated, if not impossible, if you would be more general and use the expectational inner product. Another reason might be that once you go to data, all observations have the same probability. My own experience is that students with some mathematical background become quite confused, and I have first to tell them about the expectational inner product, and then that we make a simplification and presume equal probability. Yep.
Okay, so one thing we've done, another graph. Sorry, this is a mixture of very new and old technologies. What is all this about? In the good old days, finance looked like this. There was mean return and standard deviation of return, and we drew drawings like that. And what have we done? A big thing that we've done in the class here is this business about state 1 and state 2, and sort of the fundamental geometry that we think about asset prices in is the state 1 and state 2. This is a great time so this is the set of excess returns. This is the set of returns. This is our friend X star. You know, all this stuff, right? And what Bjorn's question was. So, for example, what's a good example? We have said that the price of an asset is E of X star times X. And then we made a drawing that said, for example, here's an asset. There's an asset here, X, and then E of X star X we thought of as the inner product between X star and X. So where the equation says second moment, we made a graph that said that's the inner product of those two vectors. Everyone along to the right here. What's the mathematical justification for that? That is, this is from the Hansen and Richard paper, putting second moments into this inner product space, which I find really useful. Mathematical justification really is not drawings like that. The mathematical justification is if you look at the properties of a second moment, it has the properties of an inner product. You can define an inner product X star X by E of X star, and if you just look at what an inner product has to have, then the second moment for a set of random variables of finite variance, that has to be, it obeys the properties of an inner product, so we can just draw drawings like this in order to keep track of second moment mathematics. Now, one way to interpret the drawings is it really is an inner product if these probabilities are the same, but I wouldn't emphasize that. I think the right way to think about it is not the equal probabilities thing is just a way to interpret the drawings. For mathematically oriented people, the right way to interpret the drawings is simply I define the inner product that way. So I can think of drawings where inner products are right angles to each other. So it is not necessary to assume that all the states have equal probability in order to use second moments as inner products. Okay?
Okay.
You guys have to check on me. Did I say anything vaguely understandable in response to that question, or can you think of a better? Because a lot of our job here is to interpret the questions, figure out what they're trying to ask. How are we doing? You're doing good. Okay. Another question, or comments from the peanut gallery, if you guys have one. Also, Leonard, George, and Charlie, if there's, as students in the class, if there's things that we talk about here that you found confusing, please do chime in and let's help to clarify things. That's what we're really here for. Okay, next.
Good. I can ask another question from the forum. Moreno has a question where he tries to sort of map the lessons from class into what we read in the newspapers. And this is a question that a lot of students have been asking on how to map our framework into countries with negative interest rates. So he writes, we learned that we have positive marginal utility of investors. Can you guys see what I've drawn here? And we also know that the discount rate is positive. The discount factor is positive. So this would imply that we have positive risk-neutral probabilities. And then he asks, how can we reconcile this framework with the fact that in many countries, Switzerland, Denmark, Germany, etc., interest rates in some segments of the term structure are negative? should we say that investors of the German Bund have negative marginal utilities, or how should we, how can we reconcile this fact with the lessons from class?
This is wonderful. I've been looking for quiz questions. That's a great one. Guys, have you figured it out yet? So let's do our basic equation, which is 1 equals, I'll write it as E of M times RF, right? Because it's a risk-free rate, so it comes out. And that says that RF is a 1 over E of M. And so if M is greater than 0, it looks like RF is greater than 0. Correct? Now, can you guys see the equations here? Is that big enough to see the equations?
Yep.
Yes, I can see.
Okay. Yet the newspapers say that Switzerland has negative interest rates. What's wrong? The theory of the newspaper?
Gross. Isn't that gross?
Gross! Exactly. This object. So currently in Switzerland, what's the interest rate? Is it what, minus 50 basis points?
I think already 75, but
I'm sorry.
I think maybe already minus 0.75.
Minus 0.75. Okay, a minus 75 basis point interest rate is the same thing as RF equals 0.9925. Did I get that right? Yeah, I hope so. So RF is less than capital R. It's gross, not net. So there's nothing wrong in our theory with a negative real rate of interest. And in fact, negative real rates of interest happen all the time. There's a negative real rate of interest in strawberries between summer and winter. Because Adam seems to like that one. Negative real rates of interest can happen if goods today are much more expensive than goods are going to be tomorrow. There's nothing wrong with negative real rates of interest. Now, it's a little weird to think of a negative real rate of interest in a production economy because we sort of think of storage. Strawberries can't be stored. That's the problem. Storage or marginal product of capital being negative net real rates of interest. The issue that comes up really, the right equation to think about this puzzle in the newspaper is the arbitrage equation. And the arbitrage equation is between cash and bank accounts. So if bank accounts are offering negative 75 basis points and you can stuff cash in your mattress, that's an arbitrage opportunity. That's the zero bound on interest rates is why do people suffer negative 75 basis points in a bank when they can just stuff cash in their mattresses? Well, mattresses tend to burn up occasionally, so 75 basis points turns out, the lower bound turns out to be somewhere around minus 1% a year. If this keeps going, we're going to see businesses, we're already seeing businesses that will take stacks and stacks of cash and will put them in vaults for you, and they won't be able to lower much less than that. Okay, great quiz question. Thank you.
As a follow-up quiz question, what would be sort of hypothetical, what would be an interest rate that would invalidate our model? So if we had, I guess, minus 110%, not basis point, but percentage points interest rates, would anyone ever want to park their money in at that interest rate? And then obviously, no, that wouldn't happen because you don't want to give away more than what you're putting in the bank in the first place.
Yeah, right. I mean, I think the puzzle of interest rates, the real puzzle. So we've understood the gross versus net thing, and by the way, this is important, and this comes up. Most of the trouble you have on the problem sets and in real life is getting the units wrong. Is it gross? Is it net? Is it log? Is it monthly? Is it annual? Is it continuously compounded? Is it discretely compounded? I mean, and this stuff matters. George probably can attest. If you get gross and net mixed up, and you know you don't get a second chance when you actually put the trade on, you got to get this stuff right. The puzzles of interest, the real world puzzles of interest rates is in the 1 equals E of M times, let's say, R1 minus R2. In the world of bonds, there are many very, very similar looking bonds that pay different interest rates. So a 75 basis point difference between bank accounts and cash, that's a puzzle. a 20 basis point difference between on-the-run securities and off-the-run securities. The big puzzles in interest rates are these apparently small, but things that look like arbitrage opportunities or very high Sharpe ratio opportunities. Okay, next question.
Okay, so the next question is from Qiu Ning. He's studying finance in New York. Besides, he has a background in physics. In the lecture about risk sharing, you talked about everyone sharing the same risk shocks because of the low fund price. Everyone should share the same consumption margin. However, why can't people have different impatience instead? The beta coefficient or delta in continuous model. People may base their consumption plan on past experiences or consumption growth. For some people, they enjoyed higher growth before, resulting in higher impatience and consumption plan more focused on now than future. I know this will lead to unreasonable end game for consumptions. If you have consistently higher consumption growth, you will eventually be the size of the whole economy. But it can be a long quasi-equilibrium process and move from people to people in turn. Maybe economy works this way like in evolution. There is always some species enjoy higher than average growth because those have lower growth will fade out eventually.
That's great. There's about 3 questions in there as usual. So, but this gives me a chance to review several of the points of the class. So basic risk sharing and also this question of different utility functions keeps coming up. So let's CT plus 1. Remember how different utility functions work. Your utility may be there. I may be there. So I've drawn 2 utility functions where 2 people. This actually answers the question a little bit. What's the equations behind the difference between red and green? Green has blue here. Blue here has higher gamma. Right, that blue, I made it more curved so that the blue is more risk averse. But CT plus 1, these guys are more patient. So the questioner asked about patience, right? The red one wants consumption later. So that means the red one has, let's see, the beta is lower. This is a patient consumer, and that one's impatient. So you can differ along beta and gamma. So what have I emphasized here? Preferences may differ. And when preferences differ, we adjust our consumptions, but to the point where our marginal rates of substitution are equated. Using our power utility function, let me write the perfect risk, when markets are perfect, let's write it as beta I times CIT plus 1 over CIT to the minus gamma I equals beta J, CJT plus 1, CJT to the minus gamma J. It's marginal utility. Can you guys see that equation? Is that big enough?
Yeah.
It's marginal utility growth that's equated, not consumption growth. And exactly as the questioner said, so I guess my I's and my J's aren't that distinct. This is a beta J. These are all J's over here. If Mr. J has a higher beta than Mr. I, then that's exactly right. The consumption growth, if this number is higher, that number has to be lower. So a more impatient person, an impatient person is going to consume more today and is going to have lower growth. So if the impatient person today has over time consumption over time might even be decreasing, whereas the patient person with a lower beta will have a consumption that's increasing over time, all with perfect risk sharing. And this is the market. This actually brings us back to I forget whether Leonard or George. I think it was Leonard's question. demographics. This is what happened. A young population might want it. Well, that's a bad example. Let me not try to tie it into everything. So patient. This is the market doing what people want. People who are patient get to invest and consume more later. People who are impatient consume less over time. Now, with the question, so risk aversion or impatience will drive these differences across people that are just fine. The market is giving people what they want. The patient people get to consume later. The impatient people get to consume now. Trouble with models like this, you can see though, with either patience or risk aversion, there is a long-run shift in the consumption distribution. And if this goes on and on forever, after a long time, you will, as you look at a moment in time, you'll look around and say, hey, look at these people. They're flying around in private jets, and these people here, they may have had a good time back then, but now so models of the distribution of income. This sort of brings us back to Piketty and the distribution of income and all these sorts of things. This model of perfect risk sharing does not mean that the distribution of consumption is the same over time. In fact, these models have the feature that distributions of consumption will widen out over time, and that the patient and risk tolerant end up owning everything. That's the way the model works. Now, what do we do in real models? In real models, there's new people come in. How do you destroy that? In a model, you have old people leave and new people come in. You have inheritance taxes. You have some churning up. That doesn't seem to be, the reality doesn't seem to do anything like that. But that is a feature of these models. So, how do we do? Did we answer the question?
I think yes.
I think we did. Yeah.
Can I ask a follow-up?
Yeah.
So when I heard that question, I thought of this famous paper by Crucell and Smith, who kind of modeled this in 1998. And in that model, it's really hard to solve. I mean, part of their contribution is that, how do you computationally solve this? And one of the reasons it's so hard to solve is you don't know where the aggregate capital stock is going, so you have to give them beliefs about the aggregate capital stock. Is there any way around that if you don't care about general equilibrium, or are we stuck in the same sort of, well, we need to model long-term consumption expectations, and so it's the same sort of computational problem to actually solve that kind of model?
Now, they tried to solve a much harder model than what our question. Our question was about perfect risk sharing.
Okay. So then we can get rid of it every period.
No, but this is a good point, because all of our discussion, all these questions are coming in. I hate to sound like the old guy. All these questions are sort of my standard coffee with third-year graduate student questions. Everybody wants to pour in needless generality. Oh, what if we've had questions already. What if experiences make people want to have different discount factors, and what if there's cultural norms that are shifting the labor market? And my head exploded. The talent of starting with a really simple model is the only way you make progress. So let's with regard to Crucell and Smith, what we've been talking about here is perfect risk sharing. Now that sounds very unrealistic. It is unrealistic, but think of the simplicity it gives you. If you have perfect risk sharing, these marginal utilities move in lockstep. So there are no idiosyncratic shocks. There's only aggregate shocks. All of our consumptions move together. That's not the way the world works, but that really makes a model easy to solve. For Crucell and Smith and a lot of the literature dealing with this, they were about imperfect risk sharing. They didn't have complete markets, and people had different shocks. So if I win the lottery, I actually do get to go buy a new car, and you don't. And so my consumption goes up, and your consumption doesn't go up. Now, if you have an economy full of people who have idiosyncratic shocks and incomplete markets, then what you have, you don't have this equality anymore. You have distributions of people. You have a whole stochastic distribution. And the problem they were dealing with is now the cross-sectional distribution of consumption becomes a stochastic thing and becomes a state variable. So the key to writing down models you can solve is to hold down the number of state variables. You want capital and technology shock and in the level of habit. You want a small number of state variables. When you have uninsured idiosyncratic shocks, then the distribution of wealth becomes a state variable. You've got a whole function that's a state variable. And Crucell and Smith had, the point of their paper was some computational techniques for dealing with that problem. But that problem, it came out of abandoning the perfect risk sharing assumption, which is fine, but just don't try to throw don't try to throw all the spices in the stew and stir it. Hope it'll come out, because it won't. Okay, on to the next.
Sure. The next question we have is a question from Artem Dyachenko. Artem is a teaching and research assistant in finance at the University of Trier in Germany. He asks, in the lecture on risk-neutral probabilities, you say that we use risk-neutral probabilities when risk premiums don't matter. Could you please explain more what you mean by that?
I'm going to erase the board while I think about that question. Okay, now let's try to tie it down to something concrete. There's two ways what we did was, we said price equals E of mx, or we can write price equals E star of x over Rf with a distorted set of probabilities. Now, one of the big things, in case you haven't noticed, my habit is to try to unite things and see how apparently different things are all fundamentally the same, and how this risk neutral versus true probability they're saying the same thing. So the issue is now which language is more convenient. And certainly it's easier. It's easier not to have the M stuff in there. The trouble being that you can't measure the E stars by just by data. They have to come from somewhere else. So let's see what the statement was. Use the risk neutral when the risk premiums don't matter. We use this, for example, for option pricing. When you're pricing one thing in terms of another, when you're doing arbitrage arguments, then the risk premiums don't matter, and it's very easy. The fact that you can't directly measure E star doesn't really matter to the calculation, and that's a useful way to do it. If what you want to do is if you want to price an option, that's why we typically use risk neutral probabilities, because it turns out that you won't have to look at data to measure E star. But suppose you want to do, I don't know, the equity premium, you're not going to get anywhere on the equity premium in the risk neutral measure, because the equity premium is all about the observed frequency of stock returns. It's all about the true measure rather than the conditional, the risk neutral measure. Guys, help me out here. Adam, Nina, can you think of a better answer?
No.
Leonard, George, Charlie, how you doing?
Well, yours was perfect.
Yeah, your answer makes sense. It just sounds like you're using other assets to sample into E stars, which is what you're saying.
So any problem can be written in both ways. So, and this is okay. Let me try to make this a general point. There's continuous time. There's discrete time. There's risk neutral probability. There's true probability. There's means and variances. There's state space notation. There's like 5 different. There's GMM. There's OLS. There's like 5 different ways to describe most things, and use the language that's going to be most convenient to the problem at hand, understanding that it could be translated into any of the other languages. So typically issues like risk and return and risk premium and so forth are best handled in true probability. Typically issues like arbitrage pricing, complex option pricing models and so forth, it works out that in those cases, you don't really need to. You won't end up having to do a lot of figuring out the mapping from E to E star. So you might as well use the E star to start with. So it's just sort of advice on which language is easiest. Yeah.
Are you just saying that that if you have a sufficient number of securities, you've formed an alternate basis that's still orthogonal, and you're just re-expressing it, and that's how you're getting the basis for E star by just observing the correct number of securities?
Yeah. So that in the case that you're pricing something by arbitrage, then the E versus E star doesn't matter at all. So you might as well use the E star notation. Right. But when you're thinking about the equity premium puzzle, you're not pricing anything by arbitrage. You're trying to understand a risk premium comparing risk. So there you're going to have to think about risk premiums.
Can I say something?
Sorry?
Can I make intervene?
Yes, please.
Okay. What is based on my understanding on this, since the risk-neutral probabilities would be as if people were risk-neutral, so they would have like linear marginal utilities. No, sorry, they would have like linear utilities. Then we are addressing a very different problem with the second formula. So in this case, the risk premium doesn't matter because we have no curvature. So we are trying to think of something totally different than in the general E of MX case. So does it make sense? Is it helpful to think this way?
Yeah, it's very. Yeah.
In the second case, it doesn't matter because we already have changed our probabilities based on our initial curvature. So this, yep.
I'm trying to write down the formula. So remember, can you guys see that equation?
Yep, I see.
Right. What you're pointing out is a way very much not to interpret. This risk neutral. So what do we do with risk neutral probabilities? We treated the combination of true probability and marginal utility as a new artificial probability. A way not to think, but that doesn't mean we are not thinking about agents living in here who are truly risk neutral and changing their consumptions as a result. The risk neutral probability says that fixing consumption margin, I don't want to think of that as a general equilibrium where people change consumption streams in a risk neutral way. That certainly seems to be wrong. The way to think of risk neutral probability is that given the consumption stream, we can think of two things happening. Given the consumption stream, oh no, right. In a risk neutral, yeah. This is a very subtle question. In the risk neutral world, yeah, you have linear utility, but you don't feel like doing anything about it. You're happy holding the consumption that you hold anyway. Really, the difference, and it's why this is so attractive. This also captures the difference between behavioral and rational economics. What we can think of, we can think of risk premiums as people are scared of certain states of nature, or we can think of risk premiums as people overweight the probabilities of certain states of nature. And both of those things, those are two different perspectives of asset pricing, which are both useful, and they're observationally indistinguishable. Are people really, are there high margin utility states that don't happen that often, or do people think that bad things happen more frequently than they really do happen? It just expresses those two different observationally equivalent ways of understanding risk premiums. Okay, that's the best I can do. Maybe one more question? Adam, Nina, you got a good one from the forum?
Nina has one, but Nina, you're muted.
Now I'm unmuted. So there is a short question from the forum from Jack. He asks, what sorts of distortions arise due to tax? Yes, I know that it will affect the X term, and in turn we should expect that to be reflected in the price. But how much does it influence the time horizon and on would hold on to stocks?
Yes. You can tell. Part of why I hate taxes is because they make my life hard as a financial economist. And not just that I don't like paying them. I don't like complexity. So taxes will distort things here. Of course, what matters is the margin utility of after-tax consumption. So exactly as Jack said, they're going to distort the X's. You only get after-tax rates of return. They're going to distort the U primes because you only get after-tax consumption. And they introduce distortions, and this has general equilibrium effects. They distort asset prices. So, for example, municipal bonds pay a lower rate of return than Treasury bonds. Why is that? Because you can take, in the U.S., you can take the interest on municipal bonds off your taxes. So there's a whole literature on understanding the spread between municipal bonds, which are tax-free, and Treasury bonds on which you have to pay taxes in terms of the tax bracket of the investors. And it gets interesting because, of course, what you get is clientele effects. People who pay a lot of taxes by municipal bonds, people who don't pay taxes by Treasury bonds. So you can't. This is a case where we can't just treat investors as one homogeneous bunch who all pay the same tax rate. Instead, what you get, the tax rate on municipals is set by how are the total supply of municipals relative to filling out the clientele of municipal bond people. So for anyone like, I guess, our guests, let's see, George and Leonard are both in the real world. Yeah, you guys, you got to think hard about taxes and all of this stuff. The rest of us live off in this academic ivory tower where we can ignore it. Now, there are lots of, so to any investor, it's really funny that they spend so much time on alpha when the first rule of investing should be don't pay taxes if you don't have to pay taxes. And alpha is a zero-sum game gained by at someone else's expense, whereas not paying taxes, well, it's a zero-sum game in the sense that the government loses what you get, but nonetheless, it's much easier to pay less taxes to be tax efficient than to get alpha. And so some of the, I don't understand why hedge funds realize short-term capital gains, for example. In the U.S., if you realize a capital gain in under a year, you pay more taxes than if you hold on to it for a year. And you're right, this short-term, long-term thing that was mentioned. There's lots of ways to reduce the taxes, which just means keeps lawyers and accountants in business for a long time, which may be why the tax code is so complicated. So help us out. So closing comments from all of you. You got some, I just kind of waffled here. Yes, there's a huge literature on putting taxes into it. Taxes belong. Taxes are vitally important for doing your investments personally or in industry. Why am I not talking about it? I'll fall back on the usual. We do the simple model first and we add taxes later. And also just because it's horrendously complicated. Some perspectives from the real world. Leonard, George, how do you guys put taxes into your investment thinking?
We model things pre-tax and then worry about taxes in our models afterwards.
Well, wait a minute, because so much of what you do, you can't model. So you don't want to take short-term capital gains and then say, well, we'll worry about it.
You discount, actually, if you want the complicated answer, you discount after-tax distributable earnings, so you have to factor in regulatory capital and taxes and all sorts of other, and whether there are limits on state law and how much you can dividend out of an insurance company, and so the real answer is that there's even more than just tax.
And then it depends whether you're, is your client a tax-free endowment, or is your client the tax rate in certain situation? The client matters.
Is it an insurance company? Is it a pension fund? So it matters who it is.
George, or does the joke about Greeks not paying taxes? Sorry, we have to end with some levity.
Well, the worst, I don't know, we don't pay taxes. We don't like to do it. So what actually is happening in FX trading, the options that the derivatives that we're selling are called CFDs, or contract for difference. This is tax-free in Europe, in whole Europe, and in Greece also. So we don't have to worry about tax so much. So it's not like the dividends that you tax them.
Wait, you got to explain this to us. So it's a contract for the difference. So I make a contract on the euro going up relative to the Swiss franc.
Exactly.
And then say the euro goes up and I make money. I don't have to pay taxes on that?
No, you don't have to.
No capital gains, no income?
No, you don't have to. You have to declare it if you buy a Ferrari. So the state would know where you got the money from, but it's tax-free.
I'm floored. And so this shows my American prejudices about high-tax Europe shown to be false myths again.
This is the reason why CFDs are not allowed to be traded in the U.S.
Right. Well, one of our embarrassments is our tax code. On that note, I think we've done. Thank you, everybody, for joining us this week. This has been a great week, especially Leonard, George, and Charlie. Really appreciate your contributions. Adam and Nina, thank you again, as always. This course would fall apart without you.
Look for my forthcoming paper, short-term capital gains taxes as instrument for hedge fund sophistication. I'm going to Google Scholar that right now.
And I'm sorry, is that your paper?
No, I'm joking. I said you can look at short-term capital gains as an instrument for hedge fund sophistication. So you can sort hedge funds into sophisticated and unsophisticated, right?
That's an interesting idea. On the other hand, maybe their clients don't care. Maybe it's an instrument for hedge funds whose clients are so sophisticated they don't even have to bother worrying about short-term capital gains. Okay, thank you very much, everybody. See you next week.
Thank you very much. Bye-bye.
Bye.